Itay Goldstein is the executive editor of RFS and also a professor from University of Pennsylvania. He has been very supportive of our FinTech initiative from the beginning. Actually, RFS is one of the leaders of FinTech initiative from 2017. They have a lot of driving force behind all the FinTech publications. Yeah, everyone probably knows Itay's work and research very well. Without further ado, I will hand it to Itay. Thank you.
Okay. Thank you very much. You hear me okay?
Yes.
Yeah. Okay. So thank you, Bakdong and Sean, for organizing. I guess there is a third organizer who couldn't make it because of COVID. So thank you to the three of you for pulling it through. We had a lot of exchange over the last 2 months, and I encouraged you to continue with the plans to do it in person, which I think is absolutely essential, and I'm happy to see that it worked out and a lot of people are here. So I will talk about, as the title suggests, FinTech, decentralization and utility tokens. I'm going to start with sort of a broad overview of what I think is one of the most important themes of FinTech, which is centralization. And I'll talk about why this emerged as a key theme of FinTech, and what are some of the challenges that operate against it. Then I will connect it to utility tokens, which I think are an important tool in order to try to achieve decentralization, and talk about very briefly in the form of an example on a paper that I had recently on that make the point about the importance of utility tokens. And then I will conclude. So let's start with decentralization and its challenges. So as Barzon mentioned, we started the FinTech initiative at the RFS back in 2016. This is when we sent out the first call for papers for a FinTech initiative. It was a registered report and promised a special issue. And this was kind of an emerging topic of research at the time. And one of the pushbacks that we always got when we talked about FinTech, and we still get, is what's new about FinTech. And, you know, when you think about the industry, people, they're not really bothered by this. They talk a lot about FinTech. They always sell it as something new. But I think when you deal with academics, people ask questions, and you know, we are sort of committed to think about things in a more disciplined way. So it's important to really address this, you know, what's new about FinTech. And one of the things that people always say is, you know, FinTech was always there in some sense, because technology always influenced the way that the financial industry operates. People mention the ATM and the Excel and all this, how they transform the way that finance works in different ways. So when we wrote the introductory article back then to the FinTech initiative, we pointed out two things that we think make it special. One thing that we said was that the pace at which new technologies are being introduced is faster than ever before. And the second, which is probably more important, is the fact that a lot of the innovation is coming from outside the financial industry, and that there are a lot of young startup firms and also big established technology firms that are essentially attempting to disrupt the incumbents. Okay, so reflecting on that with perspective of a few years, I would like to focus on one key theme. It's not the only one, but I think it is an important theme of FinTech that is related to the two features that I mentioned in the previous slide, but also receives a lot of new momentum as we go along. And this is the idea of decentralization. Okay, So, everyone knows now is talking about DeFi, decentralized financed. That certainly kind of took over as maybe one of the central themes and central terms that you hear about fintech. So I think decentralization is really emerging as maybe one of the distinguishing features of the fintech phenomenon. And we have to understand what it is, why it's important, and also what are the challenges that people are facing when they think about decentralization. So first of all, we should recognize that traditional finance features central players, such as financial intermediaries and governments. They take an important role in the industry. They facilitate transactions and record keepings and so on. And financial technologies and their applications are really motivated by the attempt to break this dependence. A lot of it is based on the distrust in central players that gained momentum after the crisis of 2008. So if you think about sort of the origins of fintech, I think a lot of it can be traced to that. And then the idea is that decentralization is going to alleviate the systemic risk from the failure of a central player. And also, and perhaps even more important, that decentralization is going to eliminate market power and rent extraction by large intermediaries, and as a result is going to enable the financial industry to work at higher efficiency. However, as we accumulate experience in the development of fintech, I think we realize that it's really not that simple. And there are a lot of challenges to decentralization, and really the sort of big intermediaries and big players are pushing back and trying to justify their existence or maybe create a new role for themselves. A couple of examples. When we started the FinTech initiative at the RFS, one of the biggest themes at the time was the peer-to-peer lending. In fact, if you look at the submissions that we got, a lot of them were peer-to-peer lending. And the idea back then was, you don't need banks to lend because you will just have these platforms and people will lend to other people and so on. That really didn't go as planned. And I think that financial intermediaries kind of took over and are dominating these to a large extent. Then you can think about blockchain. And the whole idea about blockchain is that distributed ledger and no one has control. But a lot of paper and people here in the room wrote about it quite a lot. Basically point out that it's, again, not that simple. And even within the blockchain economics, there are forces that push back towards centralization. So we hear mining pools. We hear about some participants who are able to make large investments in equipment and as a result get advantage over others. And the whole thing about blockchain is the governance structure, the fact that no one has control over how the blockchain will operate. However, once you have a mining pool and once you have advantage in equipment and technology, then you're also at a better position to affect the governance. And all this has been pointed out in various papers. And I think when you think about it, we realize that at the end of the day, there are benefits of intermediation that have been highlighted in the literature, in the finance literature over 30, 40 years and more. You think about monitoring, you think about liquidity transformation. This is what big intermediaries have done over the years. Those benefits are still there. And, they kind of manifest themselves again and probably create room for some centralization, some intermediation, even in the context of fintech, when the goal is really to do things in a decentralized way. And finally, I'll say on that, we know of the so-called impossibility triangle when you think about blockchain, and this is that you cannot achieve those three things at the same time: consensus, decentralization, and scalability. So you can achieve two of the three, but not all three. So in some sense, if you want to go with decentralization, either you're going to have problems with scalability or you're going to have problems with consensus. Of course, these are all things that are still being developed and the understanding of them is still changing over time. But I think overall people would agree that there are issues with that. So really what we see is, even though decentralization is now one of the buzzwords in finance, and I would argue sort of a unifying theme that can put together a lot of the changes with fintech, people really hope that decentralization will take off and will change finance. I would say that there are big challenges with it, and probably what we should expect is that we are not going to go towards a fully decentralized system going forward, but rather something that is in between, and it's not really clear where it's going to end up. So this is sort of a broad overview of the decentralization. I want to go more specifically to utility tokens and talk about what role they can play and how they can help us with the goal of decentralization. And here I will connect to a recent paper that I have and give you sort of a brief overview of it. So as a motivation, I will say, one thing that is pretty striking is when you think about fintech, financial technology, as I said before, I think the hope is that financial technology is going to bring decentralization and break market power. But what we see in the broader economy, not necessarily the financial industry, is that technology is actually bringing more market power, more centralization, more concentration, which is kind of interesting. And this is now a subject of a lot of debate and policy discussions. You have platform companies, Facebook, Amazon, and others. Those are the most famous and biggest examples, but there are others as well. And they benefit from excessive market power. And to some extent, they do that because of their technology. There's sort of platform technology where they bring different people on the same platform and they control the platform. And as a result, this gives them a lot of power. So right now we have a lot of congressional discussions on how to regulate them. There are policy proposals that suggest that we need to break them up. But then people also realize that if you break them up, you're going to lose some of the benefits that you get from networks. So, it's not clear that you necessarily want to do that. So the question is whether fintech can help restore the efficiency in such networks. And what I mean by that is whether fintech can help us reduce the market power of the platform owner and at the same time maintain the benefits that we get from having many people on the same platform. And that is the topic of a recent paper that I have with Diksha Gupta, who is here, and Ruslan Sverchkov in Warwick. I should say both of them are ex-PhD students from Wharton. Diksha is now in Carnegie. And as I said, Ruslan is in Warwick. The title of the paper, some of you saw this paper before, the title of the paper changed, and it's now Utility Tokens as a Commitment to Competition, where we argue that utility tokens can reduce rents and improve efficiency in two-sided online marketplaces. Okay, so in that sense, those utility tokens can help us decentralize some of these online platforms that are now getting a lot of grief for their excessive market power and concentration. Utility tokens are basically cryptocurrencies, crypto tokens that are used on a specific platform. So if you go to the platform and you want to buy something, you need to use a token. And what we show in a theoretical framework is that if you have a platform like this that matches buyers with sellers, service providers with service users, this platform will tend to go in the direction of monopoly pricing. But if the platform is operating with tokens, then the tokens will push back towards competitive pricing. And as a result, the tokens can help you achieve the efficient allocation. Okay. We talk in the paper about various applications that this can be used for. Maybe the most natural one is something as simple as Filecoin. I don't know how many people here are familiar with. I suspect that quite a few. I've seen that mentioned in several other papers. But this is basically a platform where people who need storage space, they go and they buy it, and other people will provide it, and then you can use tokens to do this exchange. And this is kind of the classic, if you want, two-sided online marketplace where you have sort of homogeneous services and things are very easy to illustrate with the model. You can think about something more familiar, but also more complicated, like Uber, which is also a two-sided online marketplace where you have drivers and you have passengers, and they sort of match on the platform. We show in the paper that the arguments can go through for that as well. What makes it a little more complicated is that Uber has heterogeneous services, right? You can get a ride in Pittsburgh, in Atlanta, in Philadelphia, different times of the day. But you can basically apply the same argument for that as well. And we even take it as far as something like Facebook, where people don't directly pay each other. However, it's all based on ads, and same idea could apply if you think about how payments for ads are being charged. So let me give you sort of the gist of it, and I'll show you a quick example that illustrates how it works, and then I will also talk about some of the challenges that emerge here as well. So basically what we have in the paper is if tokens are the sole currency on the platform and there is a fixed token to service price, so basically 1 unit of service would cost you 1 token, this can restore the competitive allocation in the platform. What is crucial for that is that tokens have to be allowed to be traded in a resale market. So the service users are paying the service providers in tokens, and then the service providers are selling those tokens to the next users in the resale market. And then the price of the token in that market is going to fluctuate relative to another currency, such as the US dollar. Essentially what happens, and again, I'll go to an example, but essentially what happens if you want to think about intuition is that the tokens transfer the service into essentially a durable good from the point of view of the platform owner, and as a result, it breaks the market power that the platform owner has. Okay, so once you distribute those tokens out there, you essentially distributed your market power, and then people can use that to pay, and you can no longer be a monopoly. And connecting back to fintech, you need something like a smart contract to commit to that, because if a platform just goes out there and say this is we're going to charge these prices, how do you know that this is what they will do? But once you have this technology of the tokens with the smart contract and everything is done automatically, then this is sort of a commitment device. So let me give you an example to illustrate it. And I'm going to start with the monopolistic case, and then I will show you how tokens can alleviate the problem. So let's think about 2 periods, 1 and 2. And let's say that the platform matches providers of services and consumers of services. There are competitive providers out there, and they produce the service at a cost of C. And then there are heterogeneous consumers who value 1 unit of the service every period, but they value it differently. And you can think about a fraction alpha H of them valuing it at VH, and a fraction alpha L valuing it at VL, and both VH and VL are higher than C. So the optimal allocation, the first bet here would be that everyone gets the service. Okay. However, once you have a platform that controls the whole thing, they can act as a monopoly. And under some parameters, basically what they would choose is they would choose to ration the service, charge prices such that only those who value it higher are going to get it, okay? So the platform owner is going to pay the providers fee per unit that is being provided, and then will charge VH and serve only alpha H consumers, and this is an inefficient outcome. Okay, and you can think about it here in this picture. So basically what happens here in time 1 and in time 2 is identical. You have alpha H who are valuing it high, alpha L who are valuing it low. The monopoly is doing the calculation. It's better to serve alpha H consumer for a price of VH than serve all consumers at a price of VL. So basically they keep the prices high, and not everyone is getting the service. Okay, so that's kind of a monopoly problem that emerges in this platform. So now, how do we think about tokens, and how are they going to change the economics here? So again, sticking to this two-period example, you can think about time 1, the token market opens. The entrepreneur is going to release a quantity of tokens Q1 that they choose, and the consumers are going to buy them for a price of P1, which is determined endogenously. Then there is the platform market, where the consumers get the service and the providers receive the tokens. So at that point, the consumers basically go to the providers, pay them with the tokens, and then the consumers consume. Then at time 2, the token market opens again. The entrepreneur is now going to release a new quantity of tokens, Q2, but these are not the only tokens that are in circulation. You already have the tokens that the providers had from the previous round. So the providers are going to be there and sell tokens, the tokens that they have. And then the price of the tokens is going to be determined. The consumers are going to buy the tokens for a price of P2. At that point, the platform market opens again. The consumers get the service. The providers receive the tokens. And then it goes on. Here, it's just 2 periods. So at the end, there has to be a possibility for the providers to deem the tokens for C against the platform. Otherwise, the whole thing will unravel. But obviously, if this is a very long timeline with many periods, then this doesn't carry any significance. So think about what will be the problem from the point of view of the platform owner now. And now time 1 and time 2 look very different. At time 1, the platform again will choose to ration the service and essentially set a high price for the tokens, release a smaller quantity of tokens, and set essentially a high price such that only those who value the service higher are going to be served. But then at time 2, now the platform can no longer profit from the tokens that have been released before. The only thing that they can do is release new tokens. So it is optimal for them to release new tokens, and they will release just as many tokens as needed to satisfy those that have a lower valuation for the service. So basically what will happen is in period 1, only the higher valuing customers are going to be served, and then in period 2, everyone is going to be served, okay? And you can show that this would be the optimal thing for them to do, and you can generalize it to many periods and so on, and different types of customers, and it basically goes through that the platform will choose to basically sell tokens gradually, first capturing the market power on those who value the service the highest, but then also starting to serve the remaining populations. Okay, so here in this example, token prices will start at VH and drop to VL. And the rationale is that, again, as I said, after putting alpha H tokens into circulation, the platform essentially loses the ability to make profit over them. And so the only way to continue to make profits is to put additional alpha L tokens into circulation, and then prices are pushed down. And eventually you're going to reach the competitive allocation. The way to think about this mechanism is it's essentially a limited stock of market power. So once you have those tokens and transactions are happening through tokens, and there is a resale market for the tokens, then the platform essentially commits to having a limited stock of market power, and they decide how they want to allocate it across different periods, but they can't maintain all their market power forever. Each time they want to monetize, they have to increase the competition for themselves in later periods. And if you go back to sort of older literature on monopolistic power, it resembles what happens with durable goods. Okay, so when you have a durable good, again, every time you sell something, you create more competition for yourself in the future. So essentially what the tokens here do is to transfer the service into a durable good. Okay, and eventually, as I said, the surplus is going to be maximized just like under the competitive solution. I don't know how much time I have, but I assume not much. Yeah, 5 minutes should be okay. Okay, so a few other things that come out of the paper. So one question is, are the platforms going to choose to issue tokens on their own? In some cases, yes. So for example, we analyze in the paper a case where the platform is raising capital from future consumers who internalize their effect on the viability of the platform. In that case, yes, the platform will choose to issue the tokens. And also another case that we analyze is if the platform faces a threat from future competitors, other platforms, it may choose to operate through tokens in order to preempt this kind of competition. However, it's not always the case. And in many cases, platforms would prefer not to use tokens, but to use regular operation of the platform. And then regulation should actually help to introduce those tokens and have them play the role of inducing competition. Another interesting question is, going back to the discussions on do you want to break these platforms or not? So in the paper we show it's better to have one large platform that operates with tokens than having two platforms who compete with each other. Because with one large platform, you get the maximum network externalities, the benefits from networks. Everyone is on the same platform. So it's better that everyone is on the same platform. People benefit from having more people to trade with. And then the tokens can help get the competitive solution in this case. So it dominates having two competing platforms. And the mechanism is more general. As I said in the beginning, you can think about heterogeneous services, you can think about demand uncertainty, and different things have their nuances, but generally the argument goes through. There is an important connection here to the initial coin offerings, ICOs. So basically what I described now resembles an ICO, and we know that ICOs had a really bumpy ride over the last few years. So they had a rapid growth, 2016 to 2018, then basically almost disappeared. Regulators stepped in and made it impossible or almost impossible to do them. And I think many people think about them as basically a scam. And now I think there is a lot of regulatory uncertainty on where they're going and if they will come back. And there are talks in the SEC to have special regulation for things like that. I think what we show here is, there is potentially a positive role for coins. They can be quite helpful. And I think it's important to understand what positive role they play and also some of the features that they should work with Like for example, in our framework, we talked about the importance of having a resale market for the tokens. We talked about the fact that there should be a fixed price between the token and the service. Those things are important, and they can guide, I think, future thinking on what role tokens should play and how to regulate them. So let me conclude. So the bigger thing here is the idea of decentralization. You can think about it in decentralized finance or other technological innovations and platforms and so on. I think that decentralized finance is now one of the key terms when you think about fintech, and it clearly has a lot of positive aspects. However, there are also challenges, okay? And a few things that came out of what I said. One, there are many counter forces against decentralization. I think centralization is kicking back in many ways, and it's not really clear where it's going to end up. I think another important challenge is, and this is maybe overall kind of a part of the tragedy of fintech. I don't know if you want to think about fintech as a tragedy, but to the extent that you want to think about negative things, there are good ideas and good innovations, and they can do a lot of good in society. But then with it, there is also a lot of noise and illicit behavior. You can think about the ICOs, for example, cryptocurrencies, and that makes a lot of people out there be very skeptical about the whole thing. So I think it shows that regulation here is really important and probably needed in order to separate the good from the bad and achieve the long-term benefits. Okay, so stop here, and I'm happy to take questions. Yeah.
Seems that fixing the service cost, in the number of tokens is important here.
Yes.
In practice, it's a design parameter. So are you kind of suggesting maybe we should design, or regulators should require that in order to achieve this benefit of using tokens, as opposed to using some other numeraire or other currencies on the platform, at least in terms of the price denomination or labeling?
Yes. So that's what I would suggest here in the context of the model, because if you don't fix the exchange rate between the token and the service, then the service providers are going to compete on lower and lower exchange rates, and at the end of the day, the ability to get this and the platform owner is going to reap the benefit out of that, and then you will not be able to get the competitive solution. So yes, I would say that this is an important feature here. And again, what's important to note is you fix sort of the price of service in terms of the token. Of course, what is important to have fluctuating in the background is the exchange rate between the token and another currency. And this is something, when you think about regulating tokens, this is something that you may want to take into account. Yes.
Right. So this might be a bit beyond the model itself. Yeah. I could imagine this happening for kind of layer one, right? When it's a computation step that you require, it costs fixed number of tokens or gas or whatever. But for kind of DeFi innovation, right? Higher layer innovations, kind of pricing things in the number of tokens, pricing services and goods in the number of tokens. When token price exchange rate with fiat is fluctuating a lot, could in turn bring in other issues, right? Like basically I want to buy a coffee and the coffee seller is pricing it in one Bitcoin, and one day it's over $10,000, that day is $1. That might be a challenge too.
I think that's a good point, and this is certainly something to think about. I think what you're bringing is sort of additional volatility that affects the price of the coin in terms of, say, US dollar. So yeah, it would be interesting to introduce something like that to the model and then see what are the implications. I think it's a good point.
Yes, Itay, I have more of a conceptual discussion with you. So you raised earlier, the fintech started with the earlier paper, P2P lending. And so we always get a question from audience, like how to define fintech? It's like a question when we organize the conference, people keep asking us. So, so in your view, this is, like I said, conceptual discussion. In your view, should we define the fintech in a more exclusive way? We focus on certain topic, or you think we can be more inclusive? Like we see a lot of new area in the past 3 years, like over 500 papers. We see a lot of AI, machine learning applying financial data. So in your view, how we exactly define the boundary of this fintech definition? I just want to hear your thoughts. And also, did you see any picking up area when in your experience that can be the future of the fintech? Yeah, the area.
Yeah, you know, that's a tough question. I think so. I think you see basically two types of papers broadly defined, right? You see papers that are using sort of technology to do more sophisticated analysis, like machine learning and big data and things like that. And then you see papers on the financial industry and how the financial industry is changing through the use of technology. And I think in your conference, and probably more broadly in the profession, both of them are under the definition of fintech. One can argue with that because in some sense they are very different. I think it's fine, right? But I don't know, maybe one year you're going to get 1,000 submissions and you decide to break it into two conferences. One on machine learning and big data and finance, and the other one on sort of technology, how the financial industry is going towards fintech. You know, so far I think people are fairly happy to keep them together, but the connection is not as tight, I would say. That's my impression. Should I? Yeah.
Itay, so I found your result about the preserving the competitive power, but also preserving the network effect with a large network. That to be very cool. You didn't talk much, but I wonder if you can maybe at a high level elaborate a little bit about how your model framework actually lead to that particular result.
So say it again, which result?
Just this, you have this comment that, okay, we can have like just one large platform may actually trump two smaller platforms because it preserves the network effect.
Yes. Right. So when we do this analysis, basically what we do is we assume that there are some efficiencies from networks. So the more people you have on the platform, the higher the surplus overall, which I think is a typical assumption about networks. You want to have more people to match with. This is why everyone wants to be on Uber or everyone wants to be on Facebook. Now, if you don't have tokens, then there is a trade-off, because on the one hand, you do want to have a large platform, but on the other hand, this platform is then going to become a monopolist, so you can benefit from having two platforms competing with each other and people splitting between the two platforms. However, if you have the tokens, then you should really just stay with the one platform, because the one platform achieves the greater network benefits and at the same time can give you the competitive solution. So that's better. But there is an important assumption there, which I didn't have here, which is that you get those additional benefits from having more people on the platform. Yeah.
Yeah, so very interesting insights. But I do wonder to what extent is commitment to issuing only one token important in your model. So you can imagine a case where like a coffee vendor says, okay, you can redeem these tokens for a cup of regular coffee, but in the next period, we're going to issue a new token, a completely different class of token, which is used for getting a premium cup of coffee. So if commitment is important, can that be achieved through smart contracts, or do you need some type of reputational mechanisms to make this work?
Yeah. But basically, you know, I think it's related to the part in the paper where we discussed heterogeneity in the type of service. And what we say there is that you should basically think about different parameters that define the service. So, you know, if you think about Uber, then you can think about the time of the day, or you can think about the density of the city or things like that. And then based on this parameter, price different services with tokens. Okay, so if you want to take a a car in the middle of the day in New York, it's more than taking a car in, I don't know what, or Urbana-Champaign, not I don't think there is anyone here from. And then you can basically price it like that. I think what you're saying is, suppose that all of a sudden you introduce a new one. So, in our framework, we commit to everything from the beginning, but then suppose that you find out that there is maybe another parameter and you sort of introduce a new token for that. We'll have to think about it more, but I do think it will work. We also have an extension in the paper where we introduce demand uncertainties. So things sort of change over time, and you can generalize it to that. But the commitment is certainly important. Okay, so it's important to think exactly how that will look like. Yeah.
So I like the idea a lot of network effects being like a threat point. There's economies of scale in building a platform, but at the same time, if you can, exploit users, that creates a strong diseconomies immediately because you lose a lot if people leave the platform. What this might suggest, though, is you might be able to provide predictions on where competition is better versus tokens based on the network effect. Like, if there's strong network effects, it's fair to keep one platform with tokens. If it's like a Funko platform where you just want competition for buying dolls, maybe competition is better to lower the price of the doll.
Yeah.
In this case.
Right.
So that's one thought. The other thing is I'm just trying to understand, because you were talking about decentralization. Are we thinking about the owner getting rid of the platform or just running the platform while still having just now redeeming tokens? Because it seems like with governance, that might become an issue.
Yes. So first of all, I think you're right. I think it would be interesting to think about when this is better, in what situations you want to have that, in what situations not, and maybe there could be some comparative statics coming out of that, or some, if you want, empirical implication. Regarding your second question, so the platform owner still runs it basically, but they just lose control of prices, or at least they have more limited control of prices because there are all these tokens circulating out there. So they can squeeze a little bit more out of it maybe every period, but at the end of the day, as time goes by and there are more tokens circulating, they sort of, there is limit to what they can do. So they're still there, but they just don't have as much power.
Clarify a bit of the logic. I thought it was the force that bring back to this efficiency is because of the lack of commitment of a future token sales. Is that right or not? A counterfactual will say, okay, a big platform, he understands everything, and suppose he can write down a smart contract or whatever, committed to a future path of the token selling. Then
they don't have to
get anything, right?
They don't have to commit.
Exactly. So
yes.
Because you don't have to commit,
right.
Because you do not commit, or you do not have a commit power.
Right.
Therefore, tomorrow, the platform is competing against himself,
yes.
in some sense.
Right.
So I thought that the efficiency brought it back is because of the lack of a commitment.
That's not how I'm saying it. But yeah, maybe we can talk about it more. Yeah.
It's about time for the next session.
Yeah.
Thanks a lot.
Okay. Yeah. Thank you.